I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, the Broadcom bombshell, how the fight to close the biggest deal in tech history went all the way to the White House, and why it failed. Plus, Tesla's talent turnover. 3 senior executives hit the road just weeks before a critical progress report for the Model 3 goes public. And blockchain seizes the spotlight at South by Southwest. You will hear from the co-founder of Bitcoin rival Ethereum, Joe Lubin, later this hour. First to our lead. It was supposed to be the largest tech deal ever, but now it's dead. Broadcom's $117 billion hostile takeover of rival chipmaker Qualcomm has been blocked by President Trump, citing concerns over national security, saying, "There is credible evidence that leads me to believe that Broadcom, by acquiring Qualcomm, might take action that threatens to impair the national security of the United States." So, what happens now? I spoke to Bloomberg Gadfly columnist Brooke Sutherland, who covers industrials companies in New York, and Bloomberg's Ian King on Tuesday after the news broke.
We were talking about how it might drag on. A lot of that was based upon the fact that Hock Tan, the CEO of Broadcom, was actually in the Pentagon yesterday afternoon trying to explain himself, trying to find a way forward. A matter of hours later, the White House comes out and says, no, you don't. That's the end of it. So
very unexpected, right?
We expected it to go further, certainly.
So, Brooke, what kind of implications will this have more broadly on M&A? Let's start with tech and the tech industry.
Sure. I mean, I think the clear signal that the government is sending is that U.S. tech is off limits to foreign buyers. This is actually not the first deal that's been blocked under President Trump's administration because of national security concerns. If you remember, Canyon Bridge Capital was trying to buy Lattice Semiconductor. That got blocked by Trump. But I think the other more broader implication of this is that it's not necessarily China that's the problem here. I mean, at the end of the day, Broadcom's nationality played sort of a minor role in CFIUS's concerns with this deal. Their primary pushback was what type of company Broadcom is. They were worried that Broadcom would use cost cuts and gut Qualcomm's R&D, and that would sort of hamstring the company's ability to compete in the race for 5G. And that has much broader implications on M&A because that's what companies do when they do large M&A. They cut costs, they make divestitures, they try to make these deals accretive. So if that's now off the table and being considered as a national security risk, there's a ton of companies that maybe were looking at deals and will have to sort of hit the pause button while their advisors try to figure out what's going on here.
Ian, is there any way forward for Broadcom's bid, or is this definitely dead?
Yeah, I mean, we have to note that they haven't formally given up yet. We believe meetings are underway. They're considering what they might do, but they're
meetings with who?
Meetings between themselves while they decide what it is they're going to do. But really, the only way forward for them would be to launch a legal challenge to this. But even then, according to what we've been told, the most they would get would be an explanation of why.
Okay. And what is the explanation of why?
That is really a matter of conjecture. I mean, the thing about CFIUS is it doesn't have to explain itself. It just says security concerns, that's the end of it. But a bit more broadly than that, as Brooke said, they did say, look, we don't like the fact that we believe you don't invest in technology. That's a security concern. So apparently the definition of what is a concern has spread.
So, Brooke, I mean, this administration has sent up red flags about non-foreign takeovers. We're dealing with that with AT&T, Time Warner. Talk about just, what this means for M&A in general.
Sure. I mean, I think the signal that's being sent is that this administration is going to take a much tougher look at all types of M&A, which is not necessarily what we expected going in. Trump, pitches himself as this great deal maker, and yet he's pushing back very aggressively against deals. I think the interesting thing with Time Warner and AT&T is that it's a vertical integration deal. The two companies don't necessarily have a lot of overlap. Historically, the U.S. hasn't looked at that on an antitrust basis. They've only looked at specific businesses where there's there's distinct overlap. And it seems to be an attempt to sort of shift the purview to look at vertical integration in the same way that European and Chinese regulators do. And then again, we have this expanding definition of what is a national security concern. And I think you're only going to see that expand further. There's legislation in front of Congress right now that would allow CFIUS to take a look at joint ventures, minority investments, real estate transactions, and to further define what a national security issue is, to include technology and all sorts of other issues.
Ian, Qualcomm shares dropped on this news. Broadcom shares only slightly down. Are, executives at Qualcomm in San Diego celebrating, or, they still have a lot to figure out?
Yeah, I mean, you're absolutely right. This is by no means a victory parade for them. Effectively, they won by default. Their competitor was disqualified. They did not convince their shareholders to vote this down. Indeed, going into that shareholders meeting, which was cancelled at the last minute, they were losing, and it was looking like that board was going to be largely taken over by Broadcom. So really, that was a vote of no confidence for their management, and this is something that they're going to have to address pretty quickly.
So what are next steps for Qualcomm?
For Qualcomm, they need to get the Apple situation sorted out. You'll remember, Emily, we've been talking about this for more than a year now. They're in a massive legal dispute with one of their biggest customers, saying, we don't want to pay you for technology licensing anymore. That technology licensing revenue is a massive importance for them, very high margins, and that pays for all their R&D. They need to get that back to get shareholders back on side.
Brooke, talk to us a little bit more about the broader markets and how they might react to this bigger idea that this administration is not going to be friendly to M&A of many kinds.
Sure. I mean, I think one big open question out there is Qualcomm's acquisition of NXP. We're still waiting for regulatory sign-off from China for that deal. It's been more than 15 months at this point. There was some speculation among analysts whether China was purposely dragging its feet as a sort of retribution for Trump because of the steel and aluminum tariffs. And now I think this just only feeds the fire. And so it'll be interesting to see what happens with that. There was also some questions about the Cavium Marvell deal. Could that deal now run into CFIUS pushback, given the fact that one of these companies is based in Bermuda? Is that now considered a national security risk? I mean, it just really opens the floodgates for all of these questions and different dynamics that advisors, when they put these deals together, never previously had to consider.
So Broadcom executives are meeting amongst themselves. What is next for them? Should they decide not to move this forward?
Yeah, I mean, the point that Brooke made, I think, is a very important one. Broadcom is an American company, according to them. They were just registered in Singapore for tax purposes. They come out of a HP spin-off. They bought companies that are all American. Broadcom itself, which they acquired just in the last 2 years, is an American company. Hock Tan, he's got a Chinese name. He's a Malaysian-born person, but he's been a citizen of the US for 28 years. He's had top security clearance. Calling them a foreign entity is kind of a stretch, at least in their opinion, and at least according to all the arguments they've made. So the concern here is then, if their policy is to buy new companies and to grow through that mechanism, are they going to be allowed to do anything? And
do you think that they'll appeal?
I have no strong sense one way or the other at the moment. It's been a really difficult race to predict both ways all along.
So you still can't take a day off, is that the bottom line?
That's the bottom line.
That was Bloomberg's Ian King and Brooke Sutherland. Now to another top story of the week. Goldman Sachs has paved the way for co-president David Solomon to be the next CEO. Solomon will become the firm's sole president, and the other co-president, Harvey Schwartz, will be leaving. Goldman's given no timeline for the retirement of CEO Lloyd Blankfein. Early last month, we sat down with David Solomon at the Goldman Sachs Tech Conference and talked about the tech sector this year.
The year has set up in a way that I think it should be very, very constructive, both for M&A activity and for IPO activity. IPO activity started to pick up a little bit toward the end of 2017. We've got a very, very healthy IPO backlog. But we also have an environment, for a variety of reasons, why 2018 should set up to be a pretty active year for strategic M&A in the technology space.
Coming up, our exclusive conversation with London's Mayor Sadiq Khan from South by Southwest. His message to Uber next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. WhatsApp is throwing a new curveball into India's financial markets. The messaging app is launching a new payment service that allows its 200 million users to transfer cash to one another. Mobile payments caught fire after the government took 86% of paper currency temporarily out of circulation, which also temporarily disrupted markets. Credit Suisse estimates India's digital payments markets could be worth $1 trillion in 5 years. Here in the U.S., South by Southwest was in full swing this week. Attending the conference in Austin, Texas, the mayor of London to drum up business for his city. Speaking to Bloomberg's Daybreak Asia, Khan had stern words for companies like Uber, saying they have to play by the rules if they want to do business in London. The mayor also explained why London is the place to be when it comes to technology.
There are a number of reasons why tech companies, scale-up startups, tech giants come to London. The main reasons are access to talent. We have a talented population in London, and we're investing in the next generation, having the skills for the jobs of tomorrow. Secondly, access to capital. London is a place to come to, cultural capital of the country, political capital, and financial capital. But thirdly, our ecosystem. The proximity, cheek by jowl of culture, creativity, tech, politics, politicians, regulators, and finance explains why 40% of the world's companies have their European headquarters in London. 40%. Number two, by the way, is Paris with 8%. And so London is a great city to start a business, to scale up a business, to come if you're a big company. It's going to stay that way while I'm mayor.
Oh, of course, we've seen the likes of Google, Facebook, investing in some big European headquarters in London as well. I mean, Uber certainly, though, has been the big headlight, I guess, or in terms of being under fire under your administration when it comes to being their license getting revoked. What do you need to see from the company here for them to continue to operate in the City of London?
Well, look, Uber is a very popular service around the world. The idea of linking an app to a taxi is very, very popular. But my message to Uber, and a message to everyone, no matter how many lawyers you employ or PR experts, is you've got to play by the rules. The rules are there for everyone. And if you play by the rules, of course you can do business in London. I want London to be a place where disruptive companies come, where tech companies come. But you've got to play by the rules. The good news, the newish global CEO of Uber has a very, very different attitude to the previous CEO.
Right.
And the noises coming from him and the language from him bodes well for the resolution of the differences the regulator has with Uber.
That was London Mayor Sadiq Khan. Well, investors are lapping up Blue Apron's planned entry into brick and mortar. Shares spiked Thursday after the company announced it'll begin selling its prepared dinners in stores. No word yet on how much they will cost, but the Wall Street Journal reports the kits will be available by the end of the year. Blue Apron shares have dropped more than 75% since its IPO last June. Coming up, the Theranos endgame. The SEC accuses Elizabeth Holmes of years of lying and fraud. We will read the fine print. Plus, when it comes to retaining space rockets, Elon Musk is the king. But when it comes to retaining talent, that's another story. That's next. This is Bloomberg. A former Equifax executive is facing charges of insider trading. Federal prosecutors announced on Wednesday that a grand jury has indicted Jun Ying for selling off nearly $1 million in Equifax stock just before the company's massive data breach was publicly announced. He allegedly received information in late August alerting him to the breach, but the company didn't disclose it until September 7th. Well, Theranos CEO Elizabeth Holmes has been accused of fraud by the SEC. That is in addition to the 2-year ban she was already serving from operating blood testing labs. The lawsuit and settlement announced on Wednesday detail how Holmes and her chief deputy lied for years about their technology, snookered the media, and used the publicity to get investors to fork over more than $700 million. You will recall the health tech company claimed it could run multiple tests on just one drop of blood at a fraction of the usual cost, but was forced to shutter its labs after thousands of patients' results had to be corrected. We got the details from Bloomberg Gadfly's Max Neeson and Bloomberg Tech's Olivia Zaleski.
Just a fascinating story here and fascinating filing that was dropped today accusing Holmes of this massive fraud in which she used the media and defrauded investors. So really, if you step back and look at this company, she was promising that you could do hundreds of different tests just from the prick of a finger. It turns out that you really couldn't do more than a few dozen tests, and that they were using their competitors' technology. They also made statements such that they were going to have $100 million in revenue in 2014. It turned out the revenue was a little closer to $100,000 right there. So all sorts of bold statements, and I think it's sort of this symbol of Silicon Valley, where companies feel the need to fake it till they make it and make bold promises and actually say that those promises are a current reality.
Now, Max, I remember the customers who came forward saying their tests were wrong, and we're talking about, critical tests about, one's health. What is the scale of fraud that Holmes is believed to have committed?
So I think that's something that gets forgotten when you have such a long kind of financial fraud focused investigation and settlement. So this company, in addition to defrauding investors, also ran what amounts to, at the very least, a badly run, if not fraudulent company, promising something they couldn't really deliver. And they went on to void a bunch of blood tests that people may have made, healthcare decisions based on. So that's why I think that, even though this SEC investigation is settled for Elizabeth Holmes, this might not be the end of the story for her or for Theranos. There's still the chance that there might be criminal charges filed as well.
I vividly remember when the Wall Street Journal published its first investigation of Elizabeth Holmes and Theranos in October of 2015. She then appeared at a Wall Street Journal conference to respond. Take a listen to what she had to say at that time.
I read what was written in the article. We disagree with it. We think it was false and we think it was misleading. I know what we've done, which is the decision to voluntarily work with the agency. We interact with them all the time. We've chosen to take a path that is hard, and I believe in it incredibly strongly because it's the right thing to do. And I personally, in Arizona, worked very hard to change the law to allow individuals the right to order lab tests directly. And I can't do that without knowing that the tests that are offered are of the highest quality.
Meantime, the SEC has said, as a result of its investigation, innovators who seek to revolutionize and disrupt an industry must tell investors the truth about what their technology can do today, not just what they hope it might do someday. Olivia, what is the SEC actually saying here?
And this is a huge statement coming from the SEC, which usually doesn't make such bold announcements in the press, especially. And I think they're really saying here, we're keeping an eye on you. They're using this as an example for other large unicorns here, especially ones that are staying private longer, to let them know that they're not going to be able to get away with making false statements and that they're watching very, very closely.
Max, does the penalty here, and walk us through what the penalty is, seem reasonable?
I was a little bit surprised. Well, it's definitely severe in certain aspects. Elizabeth Holmes has to give up a large portion of her stake in Theranos. She's not going to have voting control of it anymore. But it's only a $500,000 fine from her personally. And considering the scale of the fraud here, they raised $700 million while lying to and misleading investors. It really seems pretty surprising that this is all that kind of happened, especially when we just kind of have a recent point of contrast. Another healthcare fraud for Martin Shkreli. He got 7 years in prison for what the government ended up pegging as a $10 million loss for investors. So this might not be the end of the story in terms of damages or losses.
What does it mean for Theranos investors?
So this is an interesting question. I think we're going to see a lot more lawsuits. There's more to come. The chips are going to continue to fall. I think one of the most interesting things that we're going to watch for here is that actually Elizabeth Holmes was one of the company's largest shareholders. So she is one of the largest investors herself. And in many ways, she was sort of the victim of her own fraud. We know that at this point, she does need to return $18.9 million to investors, but that's just a small, tiny portion of the $700 million that she raised. So I wouldn't be surprised if there are more lawsuits, and that if that various investors go after members of the board and various people who may have known about what was going on at the company.
It's unclear, Max, how much Theranos is really, simply one egregious example, or whether other biotech, health tech companies out there are pushing the boundaries in a similar way. What is your sense of that, and whether or not there will be, wider examinations or a wider crackdown on other companies in this space?
I think I'd come down on the side that this was a kind of isolated, if not isolated, definitely particularly egregious and unique example. Theranos operated in something of a regulatory gray area where FDA scrutiny and approval for lab tests is not quite as rigorous or consistent as you might get for drugs or other things. And I think there's still a lot of interest in the sector for companies that actually, have a better track record of explaining what they do and how they do it, as opposed to Theranos, which was a lot more secretive. You're definitely going to, I think, see a lot more scrutiny and a higher level of diligence, especially for, in the case what you had in the case of Theranos, where it was investors who weren't really subject matter experts investing in something that was a really complicated scientific task. I mean, if you want a recent example, one of the biggest recent health tech private investments was in Grail, which is a company that's trying to develop basically a blood test for cancer. So if there's still interesting science, people are going to invest, but they're definitely going to be a little bit more careful in the future.
Bloomberg Tech's Olivia Zaleski and Bloomberg Gadfly's Max Neeson there. Well, after conquering reusable spaceflight, billionaire Elon Musk is getting ready to take on comedy. After finding himself in Tesla the butt of some satirical Onion headlines like Tesla debuts carless driver and Elon Musk offering $1.2 billion in grants to any project that promises to make him feel complete, the billionaire has been hiring former staffers and writers of that same satirical website. This is according to the Daily Beast. No word on whether the secretive new comedy project will make its debut before Musk gets us to Mars. Well, when it comes to shooting a rocket into space and landing it back on Earth, for Elon Musk, not a problem. But getting the Model 3 out the door and holding on to Tesla executives, not so much. Within the last 2 weeks, Tesla has lost 2 more top financial execs amid reports of quality issues with the Model 3, which continues to face production delays. So what can Elon Musk do to get Tesla fully charged? To answer that, we spoke with Bloomberg Businessweek columnist Max Chafkin in New York.
I think it's important to sort of point out and remember that Tesla is not a normal company, in any sense. Elon Musk is a very hands-on manager. He has a reputation for being a hands-on manager, and there's always been a little bit of this kind of churn thing going on. The other thing is that we were sort of warned about this. Musk has been talking about quote-unquote production hell, and I think even discussing various possible circles of production hell that they might be in. So the idea that you're losing some executives, that sort of makes sense and is maybe a sign that predicted thing is happening. On the other hand, I mean, this is going to be a huge uphill climb, and if they're not able to keep people, in that factory or managing the factory or running the business, I mean, that's going to be a huge problem. It's going to make it all the harder to get to these enormous numbers that they want to get to by the end of this quarter and then later in the year.
Now, quickly, Max, Bloomberg has built a special Tesla Model 3 production tracker. How is the company doing?
So, yeah, and all credit to our colleague Tom Randall on this, but basically we think that Tesla, based on the VINs that they have been putting out there, that customers have been reporting to us, and that they've been getting from the government, that they're doing about 1,000 or a little less than 1,000 a week. Now they're supposed to be up to 2,500 by the end of this quarter, so they're a long way to go if you believe our model. Now we don't know how good the model is, but it's definitely a slightly discouraging sign.
That was Bloomberg Businessweek's Max Chafkin. Coming up, Dropbox scaled back ambitions. The cloud company files to raise $648 million in an IPO, giving it a valuation well below that $10 billion it snagged in private fundraising. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Emily Chang. The first major tech IPO of the year is upon us, and we've got more details surrounding Dropbox's listing this week. Dropbox is planning to go public at a valuation of anywhere between $6.7 to $7.6 billion, a number well below the $10 billion it clocked in during its last private funding round. We got the details from Bloomberg Deals reporter Alex Barinka, who first broke the news of Dropbox's IPO plans.
So what happened today is Dropbox set terms. So basically, they told Wall Street that they're marketing 36 million shares for a range of $16 to $18 a share. They're hoping to sell within that range for their initial public offering. That implies a market cap, as you said, about 25% below the $10 billion private valuation they clocked in their 2014 private funding round. So why is this happening? Well, what I've heard from a lot of people today is that Dropbox raised money at a time when valuations were really high, perhaps a little bit too elevated in private funding rounds, and now they're having to kind of take their salt. If you look back over the last few years in terms of what Dropbox has done with their business, it's actually fundamentally improved. They've gotten cash flow positive, they've gotten closer to profitability, revenue is still growing at more than 30% clip, which is what public investors really want to see. But some of those premiums, perhaps the FOMO, fear of missing out premium, that is very real in private funding rounds, is not something that public market investors are wanting to bake into what they pay for the stock.
Now, a couple of other interesting details. They privately agreed to sell Salesforce $100 million in stock. They've also announced a reverse stock split, 1.5 to 1 for current inside investors, meaning those investors won't be as diluted. Explain what this all means.
So the dilution is basically to maintain that the employees and the existing investors do kind of hold the rights that they had beforehand. The Salesforce investment is really interesting. So this is a concurrent private placement. That means at the same time as they're doing the IPO, they're selling $100 million worth of stock to Salesforce. And this comes on the heels of a partnership announcement that they announced with Salesforce late last week, basically saying they will integrate Dropbox's products with the Salesforce customer relations management software so they can basically upsell each other and integrate these two products. But not only is it a partnership, but now it seems that it's clear that Salesforce does have some skin in the game with this large stake. It's akin to what we saw with Comcast taking a big stake in Snap when it listed about a year ago, but that happened after the IPO. So interesting move here for sure from the likes of Salesforce pairing up with Dropbox financially.
We had Box CEO Aaron Levie on the show last week. This, of course, one of Dropbox's biggest competitors, though Levie calls them more like pseudo-competitors. I asked him, is he concerned about Dropbox? This is a company that is bringing in more money than Box. Take a listen to what Aaron Levie had to say.
Dropbox's numbers are sort of a tale of two types of companies. One is a consumer revenue business, and that's about 60 or 70% of their revenue. That's end users or consumers like you and I using it for either professional or personal use cases. And then about a third of the revenue is B2B. And so that is probably the only part of the business that looks anything like Box, and that tilts much more to small business or teams, whereas our revenue tilts toward mid-sized companies and large enterprises.
Alex, would you agree with his take that they don't compete as much as we seem to think?
Currently, that seems to be the case. Dropbox has 500 million registered users. Only 11 million of those are paying, which they haven't completely laid this out, but it seems like those would probably be enterprise accounts. One of the big differences is Box has a concerted sales effort. Dropbox doesn't. About 90% of the revenue actually comes from self-service, where you just sign up for the products that you pay for. And that kind of is the difference. I know Aaron's competing with Drew Houston over at Dropbox, but it does seem like he and his company have been really focusing on the large accounts, while Dropbox is kind of pushing more of the guerrilla approach, land and expand, get in with some teams internally at big companies, and then try to figure out how to sell across its customer base from there.
Thanks to Bloomberg's Alex Barinka. Now, let's turn to Spotify's coming public debut. As we have been reporting, Spotify is bucking convention with its plan for a direct listing on the New York Stock Exchange the week of April 2nd. Bloomberg's Caroline Hyde spoke with an early Spotify investor in London.
Well, I think Spotify doesn't really need to raise money. It's a company with lots of cash, as you can read through the F1 filing documents. and they are also a very well-known brand. So I think this is rather unconventional, but it really serves the company's purposes.
But they're up against competitors such as Apple, which have phenomenal amounts of cash. Surely at some point they will tap the market, because why else have the availability of going public at all?
Well, I think it really starts with the relationship with the consumers that are using the product. And Spotify has, since the launch back in October 2008, consistently been one step ahead of the competition, and been extremely good at delighting and surprising the customers with products and suggestions, playlists, and curation that is just heads and shoulders above what the others were doing at the time. And then Apple, which is probably what everyone is thinking about here, they came to the market quite late. They bet on download as being the predominant way to deliver music, and it turned out that that was the wrong choice to make, and they came too late to the party, consequently.
And so Spotify, you think, will always be able to remain a step ahead, even when perhaps they might find avenues becoming blocked. We're looking at voice assistants becoming the way in which we consume our music nowadays. I use my Alexa and my Google Home. We've now got the speakers coming out from Apple as well. Will they not start putting up roadblocks to allow such a seamless use of Spotify?
It could very well be a change in how people want to consume their music with voice assistants. But, you know, Spotify is one of the skills in Alexa, for instance, and is functioning really, really well there. And also, we see no reason why it shouldn't be in all the other devices. That has been one of the hallmarks of Spotify's success, that they have been ubiquitous in pretty much every device there is. There is an integration that Spotify has done.
So they don't need to tap the market now. They can list in this novel way. Why come to the market now then? What is it that's driving them?
Well, I think it's fair to say that the founders, Daniel and Martin, they early on understood that this was a capital-intensive business, and they needed to rely on the private capital markets, and they raised quite a lot of money over the years, and the sort of underlying promise to most of those investors, including us, is that at some point in time there will be a liquidity event. And when you're building such a phenomenal company as Spotify, the best way to get to that point is through a listing.
And so you will be sellers on that first day of trade?
So we are owners since 10 years, and this is a fund that is in the very latest stage of its existence. So it's natural that we will, at some point in time, exit our position there. It can be done in various ways. One is to sell, of course. Another is to distribute our shares that we hold to our fund investors. And we know that quite a few of our fund investors are really intrigued about the long-term prospects of Spotify, and consequently that could be a very well-functioning option as well.
What price would you have to see for Spotify to exit?
It's very hard to say, but there are obviously many good comparables and peers that you can peg Spotify against, and
like who?
I would say Netflix is a pretty good one for many reasons.
It can get to their valuation, you think?
Well, it has a similar gross margin. Spotify has a stronger growth rate. It's international. It has counts massive amount of subscribers. I think what's perhaps even stronger with Spotify is that it's a much more cash-efficient model, because Spotify gets paid on day one for their subscriptions, and they don't have to fund entire productions that Netflix does, and consequently the cash required to run the operation at Spotify is substantially less.
You talked about how this was a liquidity event which investors such as yourself need. What does it mean, therefore, this sort of liquidity event mean for the European tech ecosystem?
Oh, yeah, I think it's phenomenal that we have the biggest listing ever of a technology company now happening, and coming from a small country up north. And it has really fueled a dynamism of particularly the Stockholm ecosystem that during my 22 years as a VC has really surprised even me. And there are lots of companies now springing up in the in the shadows of Spotify and Klarna and a few of the other big players that consists of people who have gotten their first experience with these great companies, and Spotify is probably the biggest and the finest of them all.
And we've got to go, but I've got to ask you one thing. Will we see these listings be copied? Will we see other people take the route to Spotify?
I think very few companies could match the kind of branding required. So I think the Goldman Sachs and the Morgan Stanleys can still see a good business ahead.
That was Bloomberg's Caroline Hyde. A story we are watching, one of VMware's biggest investors wants the board to end talks with Dell about a reverse merger. Jericho Capital Asset Management argues it would be a terrible deal for both the company and shareholders. Billionaire Michael Dell controls VMware as well as owning his namesake company. He's trying to bring all the pieces together of his empire under one publicly traded roof. Coming up later this hour, the majority of venture capital in the U.S. is funneled to companies in California and New York. But the Midwest, which has long been overlooked, may be the startup world's new darling. We'll hear from one VC based in Columbus, Ohio, who says Silicon Valley is no longer where it's at. Plus, we head back to Austin and South by Southwest and a talk with a co-founder of the world's second largest cryptocurrency. This is Bloomberg. Yahoo could be on the hook for punitive damages over a 2013 hack that exposed all 3 billion of its users. A U.S. district judge has ruled that victims of the data breach can seek damages because Yahoo execs didn't do enough to protect consumers, given what they knew about the breach. Earlier this month, Yahoo reached an $80 million settlement with investors over executives concealing the hack to artificially inflate the price of Yahoo shares. Now back to our coverage of South by Southwest in Austin, which wouldn't be complete without a spotlight on blockchain. Bloomberg spoke with Joe Lubin, who co-founded a company called Consensus that aims to build tools and apps needed to enable a decentralized future through blockchain. But he's perhaps better known for being the co-founder of the world's second largest cryptocurrency, Ethereum. He explained blockchain's role at the festival.
We had an event where we had probably 4,000 or so people in attendance. We're running a lounge, the Ethereal Lounge. Consensus is running that, and we've got right now a Women in Blockchain event going on as we speak. We've had events with Stephen Wolfram of Mathematica fame, and a full slate over the last few days of those sorts of activities, but also just walking around, being in all the different events around the area. Everybody's talking about blockchain either in the event or just peripherally.
When they talk about blockchain, to what extent are they not really highlighting Bitcoin? I point that out because the Bitcoin bubble has seemingly burst, even as there's a lot going on once you check out the price action of some of the other platforms and look into the demand for blockchain and for cryptocurrencies at large.
Well, it may be hard to tell because we're so focused on Ethereum. We're so focused on building decentralized applications on the Ethereum platform. We're so much less focused on cryptocurrencies like Bitcoin. Consider Ether to be a crypto fuel that powers applications on the decentralized World Wide Web. But I would argue that we've seen a correction in our space, but calling the bubble to have been popped is is a little short-sighted. I think there's tremendous foundational, fundamental work being built in our ecosystem, and it's very, very early days for the ecosystem.
Joe, throughout the first several quarters of 2017, we saw an explosion of initial coin offerings, many of which were built to run on top of the Ethereum network. Of course, lately there's been a lot of anxiety about a regulatory crackdown and the status of many of these coins. How much does that threaten the interest in Ethereum if one of the main applications of it is under so much regulatory scrutiny?
So we're extremely happy about how things are going globally with regulators. There are many different jurisdictions that are excited about tokenized securities or utility tokens that wouldn't be considered securities, and that's actually true in this country as well, in the United States. There are many great applications being built worldwide on Ethereum and with other blockchain technologies, but there are many bad projects and there are many fraudulent projects. So it is perfectly reasonable for a bit of a pause in our ecosystem. It is important, I think, for many projects to do their legal homework and issue tokens properly.
You talk about all the projects that have been launched on Ethereum that you describe as promising. The underlying platform, though, still is not particularly robust with respect to scaling. A few months ago, there was a collectible cats card game that basically brought the whole thing to a halt. What is the timeline of a roadmap where someone can launch something and it can be sort of expected to really run without slowing down the network?
So it is remarkably robust with respect to security, and throughout history, software developers have been pushing the bounds on scalability for every platform that they've been on. We've traded high transaction throughput for this new trust infrastructure that enables better collaboration. We are seeing technologies like state channels. We're seeing technologies like Plasma that's going to ramify this year in the next few months for different kinds of applications. The CryptoKitties application was one excellent test showing us where some of our clients were weak, and some of those issues have been fixed already, and it shows us how we can build better, more scalable architecture. So short term, there will be some excellent fixes in 2018. Over the next 2 years, we're going to see dramatic scalability increases.
That was Joe Lubin, co-founder of Consensus, speaking to Bloomberg from South by Southwest in Austin, Texas. Still ahead, a new frontier emerges for venture capitalists. Why startup investors are starting to look harder at America's Midwest. This is Bloomberg. More than half of all venture capital invested in the United States goes to companies in California alone. This according to the National Venture Capital Association. But is half of all the innovation in the U.S. happening here? Enter Drive Capital, an Ohio-based venture capital firm founded by two former Sequoia Capital partners, Mark Kwame and Chris Olson. Drive is now on its second fund at $300 million and has invested in 29 companies to date. Chris Olson, Drive Capital partner and co-founder, joined us from Columbus, Ohio.
I think what we're seeing here is they've dramatically exceeded our expectations. So to give you some statistics, when we first got here, we didn't know how many companies we'd see on a year. We started out, we saw about 1,800 companies a year. Last year, we saw about 3,500 investment opportunities coming into Drive. These were inbound referrals of Midwest technology companies. So, you know, that compares to maybe what a typical Silicon Valley firm would see is about 4,000. So we're not quite at Silicon Valley's level, but I will tell you there is a lot more here than even we first anticipated.
So Peter Thiel is leaving Silicon Valley for LA, calling it toxic. The New York Times just did a big story about Silicon Valley VCs visiting the Midwest, saying that Silicon Valley is over, a little tongue-in-cheek. Do you agree or disagree?
I don't know that Silicon Valley's over. I mean, to me, to say the amount of $50 billion or so that gets invested into Bay Area companies from the venture world on an annual basis, to see that that's the end, I don't know how that happens. What I do see, though, is what's happening out here is just starting. And we're seeing today is a thriving ecosystem of lots of technology startups with real innovation and entrepreneurs and founders who are creating next-generation artificial intelligence platforms, next-generation agriculture, all kinds of things in robotics, where it's hard for me to look at what's going on here and say it's anything other than the frontier of innovation. So I see what's going on here really starting to emerge and kind of catch up to what has maybe initially started in Silicon Valley.
So is the amount of investment that is going into California and New York, if it is indeed, nearly the majority of all venture capital that's invested in the United States, is that a mistake or a misallocation of capital? Or, are companies in the Midwest just coming into their own and will garner more, a larger share of that investment going forward?
I can only tell you what I see in our portfolio, which is that our companies are raising more money. And so today, from the coast that are coming in, so if I look at our portfolio now, we've raised about $500 million of follow-on capital from the coast, where venture firms from Silicon Valley, New York, Boston are flying on airplanes, coming here and saying, I'd rather invest in these companies in the Midwest than I would in the ones in my backyard. That's a new thing, and it certainly is a growing number. That number for us continues to double on about a year-on-year basis. So I think it's inevitable that more of these VCs are going to start staying here. And so I think as that starts to emerge, what you're going to find is more founders will get more capital, and the efficiency of that capital here goes so much farther. And so we've also seen a lot of technology companies that maybe have started on the coast. They're also moving their businesses here. We have 7 companies in our portfolio that have now moved here. So I think this is a trend you're going to read a lot more about. And as these companies get bigger, they're going to be more in the newspapers than they have been in the past. And I think people are paying a lot more attention now.
Luring talent, though, must be a huge hurdle. And I know you guys just hired your first female partner. What is the argument to move there, aside from the fact that it's surely cheaper when most of the talent is on the coast?
So cheaper does not help. I mean, to me, the Midwest has always been cheaper than the coast. We don't have an ocean. It's always probably going to be that way. I think the only reason people should move here and people should join jobs in Midwestern technology companies is because they believe this is their opportunity of a lifetime. And if you're somebody who's highly skilled and highly technical, and you're somebody who has the opportunity to work in any place you could work in planet Earth, you're going to choose to go to the place where you personally have the best opportunity. And people measure that in different ways. And one of those ways is certainly in looking at the amount of impact an individual can have in these companies. So I think we've got certainly seen a plethora of people from companies like Twitter and from Facebook, Amazon, Google, go down the list of technology companies that are joining the senior leadership of our portfolio companies. Those are great. But you know what? There's also an awful lot of people in these Midwestern cities that are now trained as engineers who have a fundamental understanding of these industries in which they've been working. And then if they apply that to what is kind of now a West Coast approach to building startups, they can really unleash a lot of potential. And we're seeing the numbers where today we have about 1,800 people in our portfolio. That's up from about 900 a year ago. And that number's probably going to double again this year. So access to talent here has actually been a lot easier than it is in markets that have a lot more startups that are competing for that same level of engineers and those same level of senior managers.
Thanks to Chris Olson with Drive Capital. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. Be sure to tune in this Tuesday when our Caroline Hyde speaks with Facebook Vice President for the EMEA region, Nicola Mendelsohn. Tune in each day, 5 p.m. in New York, 2 p.m. in San Francisco. Remember, all episodes of Bloomberg Technology are live streaming on Twitter. Check us out at Technology Weekdays. That's all for now. This is Bloomberg.